So hello and good afternoon. I welcome you to today's special webinar, how to trade the market opening of the US markets. My name is Jens Klatt and I'm exclusively presenting this format to you here for JFD Brokers. Yeah, so last week we had some trouble to find good spots, mainly due to the fact that there was Thanksgiving and US markets were closed. So this will change today. Let's hope that we get to see a trading range which is wide enough to trade it. So you may remember that I have a filter here which I use to filter out times of low volatility to show you that, in fact, such breakout strategies do not perform awesomely well, let's say, during such periods of time. I did the following. I summed up all the trades we did so far here since we started this series of trading the U.S. market opening. So even though we only have the pleasure here to come together once a week, nevertheless, this approach I present to you here is something you can trade every day. And I'd really like to show you from. Oh, I'm sorry. I don't even know. I think it's June. I think we started in June, but it really doesn't matter that much. When we started, in fact, the overall performance is okay if you look at the pure numbers. But if you look at the equity curve, I think it would be really difficult to, let's say, sell this to a client, someone who wants to, let's say, invest in a fund or something like or a managed account, whatever. I think he would be really skeptical if this is such a great approach. Even though I can tell you that, and this is also something we can see, the numbers stabilize here at a certain level. But let's first of all start here with the definition of this open range breakout setup. So these are the rules we will trade the market opening by. So in fact, we can't really trade the market opening today since we have to wait till 3:15 p.m. GMT, and this event here ends at 3 p.m. GMT, so 50 minutes before we finally have the open range then, which we can trade. But you can easily use those parameters since they are very easy to duplicate here, and then yeah, based on an identified advantage here, based on the moving average 10 on a 50-minute time frame. So not moving average only, but exponential moving average. You can trade in direction of the identified advantage by saying, okay, we're trading above the 10 exponential moving average here. So we are going long. We trade below that, we go short. That's it. And then we trade the break of the range in direction of the identified advantage and stop above, respectively, below the high-low of the range. Now, I already told you that I have a volatility filter included here, which I do not present here, since the strategy itself works fine with without such a filter here. So this is the basic strategy, and it depends on you how to adapt this. And also not just to the US market opening, by the way, but also you can adapt the strategy easily to the Asian markets, so FX markets here, or also European markets like Euro stocks or the DAX. So, for example, I'm usually presenting in the DAX long or short. I hold this webinar with or exclusively for JFD Brokers here too. We usually make the DAX a topic. And yeah, so in fact, with this simple setup, you can adapt it accordingly and then just trade it through. And then you will see over a long run, even though it sounds really, really easy, it generates some really good results, in fact, but in fact, not for the last 6 months. But before I guide you through this here, I want to show you a trade, since I could imagine that several people out there probably say, hey, I'd really like to see if this guy is really trading an account here, if he has positions on and so on. Yes, I do. And you can see that here. So this is the account I'm trading for my clients. And right now I have a gold position on, which is in fact not automated, this trade, but it's an approach which I call purely discretionary, based on my personal 1 second, please. Or based on my personal opinion of the market, and in combination with analyzing the price action carefully analyzing the price action, and also I'm setting it up based on not just a fundamental view, but also based on, for example, sentiment parameters here. In fact, sentiment does not play such a huge role here, but let me just guide you through why I entered this trade. In fact, I already entered it, and you can see it here. I entered it on Tuesday, the 28th of November here. So why did I go short in this region? And by the way, this is a daily chart. So just to make sure that you if you want to see the trade now in your own trading station, or the gold chart here, that you know that this is a daily chart. So I went short gold here in this area, and so far it plays out really well. In fact, it plays out so well that I was already capable of trailing my stop to break even. So I have a trading rule I live by, which says that if I earned my risk here in my trade, that then I can trail the stop to break even. In this case, it means I entered the trade here. Let's make a round number out of this. 1,293. In fact, it was 292.89. And I worked with my initial stop here at 1,307 USD per ounce. So in fact, the overall risk to my trade was, as you can see, $14. And so $14 here in terms of the gold price. And in fact, the market pushed towards, and you can see it here in this candle, accelerated a little the momentum from yesterday. And in the low, it was traded at 1,276.23, which means nothing more than the trade already moved 16.5 USD per ounce in my direction. And so I'm capable of trailing the stop to break even. And nevertheless, I hope that the market will continue its downside momentum here. Let's just see. I mean, there were plenty of occasions, by the way, in the past, and therefore let's go over to this chart here. So that's a little easier to use. So in fact, if you go to the 50-minute time frame, you can see that over the last days there were plenty of occasions. Once with the U.S. market opening at 3:30 German time, that was 2:30 p.m. GMT. There were, where is it, by the way? Oh, it's a 50-minute time frame. Yeah, that makes okay. Okay. So you can see that here, for example, there was some huge selling pressure coming into the market. That was, for example, at the beginning of November. And it happened several times. So probably you're a reader and you're familiar with zero hedge, for example. So this happened over several days, in fact, and it happened quite often here. And also here, that was, by the way, the 10th of, that was a Friday. That was 30,000 contracts, which were sold here aggressively. Here, that was in the morning. Let's see what happened here. That was 3 p.m. There were several, but you can see there were several big candles happening during the time span of the U.S. market opening, plus minus 30 minutes. And so let's just see whether this will happen today again or not. So far, I really appreciate the current price action in my direction, even though I'm not trading a 50-minute time frame. But what I would say is I'd start to really doubt whether this is a sustainable move once the market moves back here above 1,286. But before that, I probably will continue this structure here on the downside. And nevertheless, I want to show you what was one of the reasons which made me skeptical. So if you listen to the morning meeting, and if you listen here to, one second. Okay. So I made this development here topic. So probably you followed the morning meeting for quite a while. I'm doing this exclusively for JFD2. It's every morning, 10:30 a.m. GMT, in the YouTube channel from JFD Brokers. And so you probably listened to me here and have heard that I was very positive for gold into the yearly close. So meaning, in fact, I built a long position already at the beginning of October, since I expected this move here to be not sustainable. So in fact, if you carefully watch the correlation between US yields here and the gold price, you can see that if yields rise, usually gold goes down, and the other way around. And during this time here, we've seen that the market started to really aggressively anticipate a restrictive and hawkish tone from the Fed here. And so with this in mind, and after an acceleration here on the downside, I started to really doubt that there is so much further potential on the downside and also on the upside for yields, the other way around the non-farm payrolls back then, that I decided to take a long position here. And in fact, the trade played out really well. And I didn't enter it, by the way, on a daily chart, but on I think it was a 4-hour chart. Yeah, I think so. And so it got me a nice profit. I scored something like $20 on this trade, which is really nice. But nevertheless, I was nevertheless quite sure back then that there's a good chance that gold has another chance to aggressively attack the region around 1,300 USD. Unfortunately, the market, it pushed back and it didn't push below those lows here from the NFPs around 1,260 USD. Yes, but this momentum here doesn't look really strong. And in fact, over the last weeks, I really became very skeptical about the potential in gold here into the yearly close. And I don't see this let's call it golden yearly close anymore, which let me come to the conclusion that probably we are about to see another leg lower here down to 1,260 USD. Another attack, probably a break of this level, and probably also a significant push lower. In fact, and that's very interesting, gold over a time span of something like a month, from mid-December till mid-January, we are usually seeing a bullish seasonal pattern here. But before that, it's not unusual, especially over the last 2 years, in fact. So last year was thanks to Trump and the Trump trade developing here. There was a huge acceleration in gold on the downside. But this happened, by the way, the year before too. So that was here at the end of 2015. You can see that here. And gold pushed aggressively after then retracing into the year of 2016. Also here, look at this. That was... well, it's not that aggressive, right? But nevertheless, some choppy price action. It came in already bearish, you have to say that. But let's say all of those last 2 years alone, it showed that gold had some trouble in the month of October, November, and till mid-December, and took off from there. So what I want to say is that somehow, and carefully watching the price action, I became very skeptical if there's not another attack lower here. And that's, in fact, the main intention I wanted to enter this trade on. But, and this is also the problem, and mainly the problem most of the time, sometimes people really have trouble to find good spots and really get the timing right, let's say. And then something really interesting happened on last Monday. So the market pushed to new November highs. You can see that here. This candle, that's the candle from Monday. We pushed to new October highs. Nevertheless, didn't make it up to 1,300 USD. And next, let's call it psychological relevant level. And now I'd like to show you a chart here. 1 second, please. I haven't prepared it, by the way, which is a little unfortunate, but let me just show you this chart. It's from the gold future. And I've retweeted this also. So you can find this in my Twitter channel, at Jens Klatt FX. That's my YouTube channel. By the way, I like to show you something else too. But that's not the chart. The chart is... where is the chart? Here it is. Okay, 1 second. So, okay. So, this is the tweet. It's from a future trader here, Brennan and Barrett. And he showed something really, really interesting. This is also, I think it's an hourly chart, I think. Something like that, probably 30 minutes. I'm not sure, but it doesn't really matter. What this chart shows, it shows that the market pushed aggressively into those highs, 2 new November highs here, but we saw a huge turnover in this region. In fact, that was the highest volume by far, which was traded here. And this is usually a sign that the market is about to top out here. So it's not just that we see huge buying pressure here and the market pushing higher to those new November highs, but it's also, there must be someone else who's selling and aggressively selling. And usually you get to see this at turning points in the market. So we call this volume spikes. And that was a sign where I said, well, you know what? I take the risk here because the risk reward, I think, is really attractive. I take a short position here, market. So in fact, okay, I looked at the 50-minute chart and I tried to figure out whether this is probably a good spot or probably I should be a bit careful here. But in fact, I entered the trade here market and placed a stop above those highs. So here at this level, that was 1,307, and was really betting on the market to drop from here and probably accelerate on the downside, even though I said, well, what I know is, and this is something you can see here with the swap. So I held this position now for 2 days. Yes, Tuesday and Wednesday, yesterday. And you can see that I have a positive swap here. This is really great. So if you trade the gold mini contract at JFD Brokers, you earn swap overnight by holding this position. That's different from trading the it's called the big contract. So without the mini here, but the big contract. And so I have in fact time here. And the thing is, if you carefully watch the price action, and also here, like, I mean, this is, let's say it's an hour chart. It really, in fact, it doesn't matter. But the thing is that you can see it's really choppy action. That's also one sign that the market obviously has some trouble to really push higher. But there were all the time coming big sellers in the market here, pushing the market from fresh new highs back to, in fact, here it depended on how aggressive those attempts were, but usually the market was pushed aggressively lower from those new attempted or achieved highs. And the combination of all of this let me come to the conclusion that's probably a good idea to sell gold here. The risk reward was really attractive, even though I knew that I'm not right sure, or I can't be sure that the market really will take momentum on the downside here from my entry, or if it takes some time. And in fact, it took some time. That was on Tuesday evening. Well, the market dipped around ±0 a little, and then it started to gain momentum yesterday, thanks to the comments from Janet Yellen, who said in front of the Congress that she considers the current asset valuations, especially in equity markets, to be too high, and that the Fed in general is very skeptical about this. And what does this mean? It means something which is also interesting for the US market opening today, because you can, if you have a careful watch at the Nasdaq 100, you can see what I'm talking about. Usually, most of you guys will definitely had a look at it already yesterday. So the Nasdaq really fell off a cliff and really moved aggressively lower, while the blue chip sector here, especially Dow Jones, could push to new all-time highs without any big efforts here. And that was mainly probably due to the fact that there's still some speculation around the upcoming tax reform here, but which, by the way, will let blue chip companies, big companies, profit enormously. But the thing is that those comments from Yellen hint towards a probably more restrictive course of the Fed in 2018 too. So we had, and we will see, another rate hike here in December, in around 2 weeks from now. But what we can say is that so far the market only sees one further rate hike in 2018. So if this can be seen if you combine, we won't do this here since it takes a little too long to explain all this, and I did this, by the way, already in the morning meeting several times before. So you can watch up the so-called Fed Watch tool here, and you can see the probability the market is, or how likely the market sees the Fed to hike rates here. And you can see a further rate hike of another 25 basis points is already priced in over 90%. While if you now click through March, June, and September here, not covering December, but this doesn't change that much 1 year from now. So what you can see is that the market is only positioned, the majority is positioned for just one further rate hike. It's not sad that all the market participants see just one further rate hike, but there are several who also see 2 and 3 rate hikes. But the majority is what plays a very important role here, and they see just one rate hike in 2018. And now those comments from Yellen suggested somehow that the Fed will probably hike not just once, but probably twice, probably also 3 times in 2018. And this triggered some bearish action then in gold based on yields spiking higher from before coming down significantly. That's also something I'd like to show you here, so you can see the trade itself, or those trades I enter from a discretionary perspective. You really have to see the markets. I see them. So those discretionary trades are usually a combination of technicals, sentiment, and fundamentals. In fact, some of you might say, hey, sentiment and the position, open positions for market participants. Well, if you look at volume, somehow this is kind of sentiment. Yes, exactly. And the same thing is true for technicals, even though the technical thing. But yeah, technical picture here is like I see a sequence of higher highs and higher lows, but really let's call it choppy upward structure, upward sequence here. And you see this combination here, and also having a clear opinion on the fundamental picture. This is something from time to time when I enter positions then, but these positions are most of the time not just for 1 day or intraday trades, but it's trades for several days. Probably I will hold this position if I'm not getting stopped out here and the market continues to move in the right direction over the next week here. That's mainly due to the fact that we have some very important numbers presented next week. And yeah, with this in mind, you can see that it's very difficult to duplicate these trades. And nevertheless, I think it's quite interesting to get to know why I do what I do and how I position myself here. And there you can see that obviously I'm not a pure technician or a pure fundamentalist or a pure sentiment-based trader, but I'm a combination of all of those components. That's something I found out over the years. Where I traded the markets, that usually it makes definitely sense, especially if you plan to enter those trades from a longer time frame here, to have several parameters to be included in your trading. And so here, let's have a look at those interesting charts. It's from a report, from a commentary here from Jamie McGeever. It's another guy you should definitely follow on Twitter. It's a guy from Reuters. And what he describes here is the current developments in the yield curve. So looking at the 2-year, 10-year yield differential and seeing that it's the flattest for over a decade right now. And something you can clearly see here, if you go back in history, you can see that such a flat yield curve is something what usually occurs before the market entering a recession here. And this is something, especially after such a long period of time, you should see here with QE and all those stimulus delivered from the central banks around the globe, that right now we haven't seen a recession for over a decade, which means it's likely to come. If we talk about an 8 to 10 year cycle, we usually find ourselves in such a recession. So now the thing is, nevertheless, the market is very aggressive positioned already. That's something you can see. And I mean, how does he do that? I mean, he easily looks at the yields, but the market and the CFTC here especially, and if I talk about sentiment, I have to have a look here at the Commitment of Traders report too. So what the CFTC does, it shows the position of big market participants, big speculators also, the so-called non-commercials in this case, they show once a week how they are positioned. So they have to deliver numbers on their current position in the market based on the size of the position they hold. And so what we can clearly see is that right now the market obviously is aggressively net short 2-year bonds, which means they are betting on yields to rise because of obviously the Fed likely to rise rates in the near term. But on the long end here, they look at 10-year bond net positions, and they're here currently net long, showing that over a time span of 10 years, they expect the U.S. economy to cool down a little, let's say. And with this in mind, we can clearly see that over the long term, there's a good chance that the market will definitely dip into a recession here. But, and this is the thing, right now, I think it's too early to say that. And based on that, I think the market is currently too short the greenback, the US dollar, even though it definitely makes sense. If you look at, let's have a look here. Where's the gold price? No, it's not the gold, US dollar. If you look at the US dollar, what you can see here is that the market obviously is short right from the beginning of the year 2017. So the greenback is definitely short, but somehow the market is or seems to be a little sold out. And we are about to see kind of a bottom forming here. And based on the current position from market participants, being heavily short US dollar at one hand and being heavily long, especially 2-year yields, but also being long T-notes, so the future itself, which means being too short a 10-year yields. This is something where I say, well, probably we are at least to get to see a short spike in the near term. And this is highly likely to happen probably then in the next week and the next days because of some data coming in. And if those data sets surprise on the upside, starting with tomorrow's ISM manufacturing data set, I think there's a good chance that a US dollar could rally here. Yields could spike. And this also means that gold push lower here, accelerate on the downside. And probably we are about to see a quite significant attack in the near term here on the downside of this level, 1,260 USD. And yeah, so far, somehow, I'm also, by the way, betting on dollar yen then pushing higher. So in fact, we've seen a quite aggressive push already here above 112 today. Not sure if this is probably it, but I think there's a good chance, especially if this tax reform passes through, or speculation around this holds at a certain level, that yields could also trigger some further bullish action in dollar Japanese yen. If this really happens, then I know that based on the negative correlation between dollar yen and gold, there's a good chance that if dollar yen spikes up, gold will push lower. And yeah, and so that's in fact what I'm right now after here, and why I'm positioned on the short side in gold. And let's just see whether this trades continues to move in my direction. My clients, I think, would really appreciate it to see me being right here in this trade. And what you can also see is, by the way, here the take profit level, which I already placed at 1,250 USD here, which nevertheless doesn't mean that I will want to see the market to reach that level. But in fact, I could imagine to probably take this level lower here. The reason I placed it here has to do with several experiences over the past. I wasn't a victim of that, but I did not profit from it too. It is that we've seen several flash crashes happening, and one reason here for me to place such a level, it's kind of that's called a fishing level. So I really could imagine if such a flash crash happens for whatever reason, that especially if the market pushes here as low as 1,260, that it could easily trigger another $10 move lower. And yeah, based on the assumption that this is definitely too aggressive in the short term and could easily result in a more aggressive pullback, I nevertheless place such a limit here, and just in case, let's say, just in case the market really behaves that way. So far, I don't see it, but this is exactly the thing. I mean, did any of you guys, and I closed this, any of you guys expect the Bitcoin to behave the way it behaved yesterday? I don't think so. And behaving again. That's really beautiful for all those guys who are volatility junkies. I think Bitcoin is the place to be right now. As you can see here, so we traded. What was the morning meeting that was here? 10:30. Yes. So we were trading significantly above 10,000, and right now 1,000 USD lower. And again, looking for the lows here from yesterday, which we reached after pushing as high as 11,500 points. And so you just don't see such moves beforehand, but if they happen, they just happen. And if you're on the wrong side of the volatility, well, you're a really nice, you're in a really nice spot. Nevertheless, you just can't see them, and this is one of the reasons why I just placed the limit there. So yeah, that's around the gold position. Let's come back to some more theoretical stuff here. First of all, here again, the definition of the open range. Okay. Okay. I'm scrolling here through the questions before. But so far. Okay. Okay, so yeah, let's have a look here at the definition of this open range breakout setup again. So we're talking about the open range, which we have to wait to develop here from 2:30 p.m. till 3:15 p.m. GMT. That's one of the reasons, by the way, I'm completely relaxed right now, since you might wonder, okay, well, why does this guy doesn't click into the chart? Well, we could easily do this right now, and I could tell you how I prepare the charts for every trading day here, like this one, and there you see, okay, the turquoise line moves higher, but why is that? Well, in fact, those lines are easily explained. This is the trading hours from yesterday, 2:30 till 9 p.m. 2:30 till 9 p.m. GMT. So I have to calculate this in my mind here, because in Germany we have 1 hour ahead of this, so it's 3:30 till 10. And this is for today here. So this is showing the so-called Wall Street opening and with spot open when the spot market is open. The blue line shows the close price yesterday. This is here. And then you have the green line. This is all the lows from yesterday. The red line is the highs from yesterday. And the turquoise line is the first tick at 2:30 p.m. GMT. So today's opening of Wall Street, if you want. And here, the yellow line, you can see the so-called 10 exponential moving average 10 on a 50-minute time frame in this case. So which perfectly coincides here with, obviously, what I have to wait for right now is I have to wait for this range to be developed here. And then if we trade above or below that, I enter the trade in direction of the identified advantage. So what we will do here is I'll show you how this worked out yesterday. So usually we are waiting for the first 3 candles on a 50-minute time frame to develop here. 50 minutes multiplied with 3, we are 45 minutes, which means from 2:30 till 3:15 p.m. we have obviously the trading range. So we take the low here from this candle. This is 2,627. 1 second, taking it here. Click. So, and let's, I think that's one. Is this good? I hope so. I think everyone can see that, but I make a big and bold line out of this. So this is the open range. So obviously this is the high. Those 2 lines have to coincide with each other. And what do we see? Well, we see that obviously the market had an open range here between 2,627 and 2,633.8. That means that obviously the open range is not big enough to formulate a trading setup for me. You will see this. So in fact, I've prepared already something here which I want to guide you through, and you will definitely wonder, why didn't he enter a trade? Oh, I'm sorry. Yes, sure, I entered the trade yesterday. I'm sorry. That now I was the day before. That was in fact here. I'm sorry. Here. That was an open range which wasn't big enough, or wide enough. It was in fact only 4 points, but I need 5.3 points. And yesterday, yes, we had the trade. Yeah, sure. So the open range here is obviously wide enough. In fact, as you can see here, it's more than 6 points. And so it's bigger than the range width I need, 5.3. And then something interesting happens here, but the market first initially pushes here to those highs and then is coming back. And as you can see here, the trade is entered based on the break below or out of the range on the downside, because obviously the moment once we broke here on the downside, we were trading obviously below the 10 exponential moving average 10 on a 50-minute time frame. So that's the reason why we enter a short here. You can also see this here, 29th of November, it was a sell yesterday. Yeah, and it obviously sold 14.2 lots here based on a 10,000 euro account and only risking 100 euros, so 1% of the trading equity. So, and as you can see, it moved in our direction. The trade was closed automatically. I didn't work with any take profit levels here, even though, by the way, I told the audience, and this is by the way great, I have to say that from a research perspective. So some people in the German format here of this live trading of the market opening, they asked me, okay, where do we place our take profit level? And in fact, I moved as low as 2,595. And I said, well, I think this is a little too aggressive and too optimistic for the bears here. I think this won't happen. And if I had to formulate a trading setup for today and take profit level on the downside, I'd go to the region around those highs here. That's the region around, yeah, I said 2,618 to 2,619.20. And in fact, as you can see here, worked out really well. So the market triggered this level and didn't move lower than that. So in fact, the green line is the low from yesterday. But nevertheless, I didn't work with that. I only gave this idea to the audience listening to me there here in Germany. And then I took out the trade automatically at 8:50 p.m. GMT. That's just an automated strategy here. 100% automated, by the way. It only enters the trades based on those parameters. It places here the stop, in this case, above the high of the range. So what do I mean by that? The initial range, I'm sorry, the initial risk here was here. That was predefined with something like 6.5 points. So if I enter the trade here, with the range of being broken on the downside, I place the stop here at this high purple line, or at this purple line here. And yeah, so the trade was obviously here, taken out somewhere around 2,623, 624 after entering it somewhere here. So at the end of the day, giving us a profit, yeah, you can see it here, 625, 78, and giving us a small profit of 20 euros in this case, with an inertial risk of 100, which is not that great, let's say, from a payoff ratio perspective. But what you can also see is, and that's one of the reasons why I did that, I just summed up all trades. Yeah, it was July when we started. It wasn't June, it was July. I summed up all those trades, and there's this small, this little anecdote I usually tell the people here listening to that. Even though the setup might seem really rough and not really detailed, and especially after some people listening to me here right at the beginning of the series, and some might probably recall this, some might remember that, that this is a simple strategy I presented right from the start of this series here. So we're doing this obviously for nearly half a year right now. And after listening 4 weeks here, obviously you can see there were 4 losing trades. 4 losing trades. And the thing is, if you listen to that once and twice, okay, everyone can lose twice in a row. But if you lose 4 times in a row with such a rough setup here, well, I bet you won't listen to me anymore, but just say, okay, this guy just does not know his stuff, and so I don't want to listen to him anymore. And I completely understand that, by the way, but this is the thing. This is where professionalism, yeah, exactly, comes into play in trading. because what I know is that the strategy works, and this over a very, very long period of time. So what I'm talking about is the following, and I prepared this chart here already. So this is the equity curve. If you go back, here to November 2010, so 7 years from today, back in the past, a little more than that. It's the 15th of November back then. And you can see that the equity curve obviously shows in the right direction. So it's making higher highs and obviously making us money. And we have, and this is very interesting. So remember those numbers here, a 47% hit rate, for example. We have an average profit of 1.3 to 1, meaning that for every euro on average we lose, we make 130 back, 131, I think it's the current number. And this is giving us a positive expected value, and all in all resulting in this strategy to be profitable. Now, the interesting thing is, let's have a look at the current numbers based on all the trades we made back to July, at the end of July. So obviously we're looking here at a time span of something like 4 months. And the interesting thing is, I did this in a very rough way here, but I just summed up the winning trades and the losing trades. And so far, we have 20 winners and 20 losers. So 40 trades all in all. This is something you can see here. So it's we started 2, and obviously moving as low as 41. So 40 trades. And with 40 trades here, we have a 50% hit rate. It doesn't seem that great, but all in all, if you sum all those numbers up, you are ahead. It's we're starting with a 10,000 euro account, meaning that here we have a plus so far in our equity curve of 1.8%. 1.8%. Well, this is not tremendously good, but it's, on the other hand, it's still positive. Even if we subtract commissions here, which is, by the way, one of the reasons why I don't like this equity curve at all. You can see it's more kind of it has no clear and nice structure, which is, on the other hand, no big surprise, because market conditions do not favor breakout strategies right now. Meaning, if you look at the low volatility, and here the current VIX reading, for example, comes into play. If you look at this, let me just update this page here before. Currently, the VIX is trading slightly above 10. And again, not favoring breakout strategies here. But in fact, we favor volatility short and somehow equity long positions. I mean, if you look at the chart, this is also what risk parity funds, by the way, are doing. 1 second, please. Okay, so I'm back. So all in all, this overall result is no big surprise, even though you can see that there will be times when the strategy performs really well and makes us the money in the long run, resulting in such an upward structure here. You can see in this equity curve, and nevertheless, those are times, and this is part of the game and something you have to overcome when trading the markets, and where discipline comes into play. So you know that the strategy is profitable. You have a positive expected value. The numbers here, by the way, and you can see this here. This is the payoff ratio. This is the ratio of average winning trades to average losing trades, which is, by the way, here at 1.19 to 1. And as already said, this is slightly, in fact, the payoff ratio is slightly below what we could expect here for 7 years of trading the strategy. So 1.31 to 1, while the hit rate is slightly above what we should expect to have. So it's 50% instead of 47%. And now we'll do the following. 1 second. So what we will do is we'll easily calculate the so-called expected value of the strategy, average winning trade, and equals average winning trade multiplied with the hit rate. and then you subtract the average losing trade, you multiply it with the loss rate. Okay, so, and so we'll do this for two cases. So the first one is we work with the numbers based on our backtest, which is average winning trade being 1.3 to 1 multiplied with 47. I'm sorry, 47%. And then we subtract 1 and multiply this with 0.3. And if you calculate this, you get 0.08. Which is bigger 0 and obviously profitable. And now we do this with the numbers from the last 4 months. And you get the expected value, which is 1.19. The average winning trade, obviously here. You multiply this with 50%, and then you subtract 1 multiplied with 50%. And what you'll get is 1.11. It's in fact 0.595, and you subtract 0.5, and what you get is a result which is slightly above expectation, but only slightly. So we are not talking about huge variance on the up or on the downside, but we are already trading in the range of our expected value. In fact, we should expect in the near term, in the meantime, to probably drop this expected value a little. But all in all, you can see that we are so far doing quite well. And based on that, why do I show this to you? It's very simple. If you look at this strategy now, we're trading it here for 4 months. And if you didn't expect, or if you didn't believe really this to function in the future as well, what you can see is, even though we're only talking about 4 months, but it builds confidence. And that's what I want to say. It builds confidence. If you really know the strategy and that it works, and you ran a backtest and you didn't over-optimize the strategy and all that stuff, and you get such a result here after 7 years, what you definitely will build is confidence. The confidence you need to stay disciplined and just trade through the strategy, even if there are times when it doesn't work well. And so in fact, by the way, the target at our end should be to somehow try to stabilize the expected value here at the current level. So make sure that you cut losing trades short, that you somehow try to build your knowledge of market structure, for example, and try to somehow stabilize it here at this current level. Because if you're making on average something like 2 cents more per euro risk, per euro you risk, well, that means at the end of the year you're making 25% more performance than you usually should. So saying like you're trading 200 trades a year and you're trading it with a 10,000 euro account, that means if you risk 100 euros, you make on average 16 euros. But really, again, 1 second. Is that correct? No, I'm sorry. It's 8 euros. I'm sorry. 8 euros multiplied with 2,000, you come out at 1,600. 1,600 traded or profit on a 10,000 euro account means 16% profit. Okay. So now, if you can stabilize it here at 10 cents, you make on average per euro you risk, and you're risking 100 euros. It means that you're making 10 euros a trade. 200 trades, making it 2,000 profit at the end of the year on a 10,000 euro account, making or pumping up your performance, your overall performance from 1,600 to 2,000, which is 400 euros more, equaling 25% more performance. And even though that might sound very theoretical, in fact, that is what trading is about. And what I recommend my students, for example, is the following. I recommend them to make their whole trading day as boring as possible. So in fact, and that's one of the things. Just imagine the following: you have this high level of confidence. You reach this high level of confidence, knowing that your strategy is profitable. Just imagine the following: I wouldn't sit here right now and talk to you, but instead have to wait until the open range is developed. So I'd sit here 45 minutes, not doing anything at all, looking at the chart, seeing it ticking up, ticking it down. And then finally, giving in the order once I have my open range defined. I look where's the high, where's the low. I look at where's the advantage. I type in the order. That's it. And then the order is triggered. This is the only work I have. In fact, then I wait till the order is triggered. If it's triggered, I take out the other order. If I'm working with something like an OCO order offered from my broker, in this case JFD, which is offering exactly that, this is automated too. So the only thing I have to do, in fact, is to wait until the trading day is over. So what I could easily do here is then trade other strategies to somehow make sure that I stabilize or that I get a good balanced portfolio in terms of traded strategies. But all in all, my trading day, if I stay disciplined and if I just focus on what matters in trading, which is optimizing my expected value, which is hopefully positive, where I know that it's positive, well, my trading day, all in all, is very, very boring. And that's one of the reasons, for example, there are people out there writing books or so. So definitely, I know some guys. I also know guys who have no clue about trading, but are writing trading books. You should stay away from these guys. It's difficult to do that because they can sell enormously good. But I definitely know people writing, for example, trading books and also trading highly profitable in the markets and really know their stuff. And the reason why they do that is because everything else is just boring, sitting in front of a screen and make the whole progress as boring as possible somehow. And by the way, I think that this does not necessarily coincide with what you get usually to hear when talking to so-called gurus or so. They will make trading something enormously fascinating and adrenaline will push through your veins and you will be excited well, no. Professional trading, profitability in trading is nothing compared to that. And really professional traders just can smile about that and laugh about it and just say, okay, well, I'm not sure, after listening to something like that, I'm not sure whether you're really a professional trader or not, because usually professional trading, profitable trading, is something really, really, really boring. Nevertheless, don't get me wrong, at the start of the day, you just don't know if the trade will work out or not. And this is the next thing. So even if you're having a position on, sometimes you have to somehow intervene. Some people do that. Some purely automate their trading. Some are intervening from discretionary perspective. For example, then using techniques if the market does not move their direction. For example, scaling out of losing positions, taking out half the position to make sure that here again, if they get stopped out, because they have a clear idea of usually what the average, let's say, duration of the trade is. Oh, I'm sorry, that's not right here. What's the average duration of the trade? And if they find out that in, let's say, 80% of the cases, and you see that's a game with numbers, if they see that in 80% of the cases, for example, the trades which do not develop in their direction in the first 30 minutes after they entered the trade, that those trades are in 8% of the cases end as a losing trade or will be stopped out, well, what makes sense? It makes definitely sense to scale out of this position, take out half of the risk at least, and that way trying to bring down the so-called average losing trade. Why is that so important? Yeah, obviously, you subtract, if you bring down the average losing trade, you subtract a smaller number then from the average winning trade, which will stay at the same, which will pump up your expected value. That's what positive optimization of the expected value comes into play. Yeah, so that's around my thoughts here on the market opening. So again, let's have a final look here. What's happening so far? Can we already see the open range to be big enough? Can we say that? So the low is 2,635, 264. No, in fact, we still have to wait. Or do we have a high here? 639. 639. It's close. It's right now, it's close. So we need another 0.2, 0.3 points to have an open range which is wide enough. But if we have it, we definitely have a setup for today. So based on the open range then. Let's have a look here in the last minutes of this event at the DAX. Wow, this is so crazy. Really, okay, let me put it that way. I have an automated strategy I'm trading in the DAX. That's something I can tell you. And several people listening to me in the daily morning meetings know that already. And nevertheless, yesterday, for example, a very good friend of mine, we work out 3 times a week, and this for years now. So he's my best friend, if you want. And he asked me, after knowing that I'm a trader, okay, this is something he knows for quite a while now, several years, but I'm usually also talking about him some strategies I'm right now testing, respectively trading, especially not just testing but trading, and actively trading. And he asked me, hey, so what about the DAX? What about Bitcoin? He came across this topic. So usually he is not that familiar with financial stuff, but right now everyone is talking about Bitcoins. Also, the German media is taking over this topic here and making it a big topic, which is, by the way, a first sign of that we're probably at least seeing a short-term top here. And by the way, look at the Bitcoin chart right now. So the timing is perfect of German media. Sometimes German media is not that competent in terms of financial things. Let's put it that way. But let's come back here to the DAX. So he asked me, hey, what about your strategy? You're trading. And so far, I'm doing really well over this year so far with this strategy. It's a very conservative approach, but nevertheless, I told him, yet right now I'm not trading the strategy, since I don't have, first of all, I don't have a good feeling, and second, the structure in general, the market is in right now. The DAX here is not favoring this trading approach. Let's make things simple here. So I took out the strategy, and the main reason I did this is, in fact, to again optimize the expected value. So in fact, what I can tell you right now is that this is the last trading day of the year, and my discretionary intervention, taking out the strategy, results in me performing 500 points better than the strategy would have performed if I just let it run from the beginning of the month till the end of the month. So with a good risk and money management plan, that does not mean that I'm crashing the account, even though 500 points may seem a lot to several guys listening to this right now. But 500 points is still in a range which is okay. But if you are just losing 0.5% for the month instead of 5%, this is a huge gap here. And especially your clients, where you trade for which you trade their accounts here and their money, they highly appreciate it. Even though they say, hey, I'd really like to have a plus here in my account, but if I have to choose between minus 0.5% and minus 5%, I take minus 0.5%. And so in fact, I took out the system so far, and that worked really well after I saw that the equity itself was trading around plus minus 0. So there were times when I was ahead for the month, but there were also times when I was behind. In fact, by the way, if I close out the gold position right now, I'd be ahead for the month. So yeah, even though we are right now pushing back here slightly back towards 1,280, but if I take out the position, I close the month for a small profit here. Nevertheless, I don't plan to do that, since that doesn't make sense if I'm aiming for another 40, 50 bucks on the downside here per ounce. But so now the thing is that if I look at this, and this is what I want to tell you, if I look at this thing here, so in the morning, in fact, the strategy would have been long today. The strategy would have been long, and if you look at this, then you might say, hey, really? So you see that the system being long and see the market pushing here significantly upwards. And nevertheless, you can't look at it that way, because you say, hey, I performed 500 points better. And so the thing is, I have to swallow such a development here, even though it's not very nice to look at. But the thing is, I just don't know when the market will move in my direction, but I can see a probability of being on the right side, a high probability or a low probability. And since I right now expect it to be a lower probability, I take out the system. What I see right now is that obviously from those gains, everything and nearly everything would have given back. Let's just see how the rest of the trading day develops here. But so far, I think it's not such a bad idea to take out the system and stay away from the markets right now, especially in the DAX. For example, I performed a little better last week on Friday. I really performed a little better than the market, and well, I think by taking out the system, I made 40. I saved 40 points. In fact, it was very close. That was 1 or 2 points here, and the trade would have been stopped out, which would have made me or brought me a performance of better 150 points better than the system, and. So why do I tell you all this? Because it comes all down, when trading the market, it comes all down to optimizing the expected value, which you definitely have to work out. You can't really tell whether those numbers will be the same numbers 1 year from now, and if your win rate will be the same, the average winning trade, average losing trade. But if you have those numbers, you can definitely, and you will, not you, you will have a higher confidence in your trading and have a huge advantage in front of all your competitors out there. And you will definitely start to really think about your trading in terms of how can I optimize what I did today, and not necessarily thinking about, hey, did I win or did I lose today, which will definitely calm you down tremendously. And yeah, next live trading session here will be next week then on Tuesday. No, I'm sorry, Thursday. And that's it from my end. Happy trading. Watch your stops, and talk to you again then next week on Thursday. I definitely look forward to it. Yeah, if you have any questions, shoot me an email or contact me via Twitter. Use the chat box here below the video. I definitely answer your questions. I'd be happy to answer your questions. And yeah, so have a nice evening. See you, and bye-bye.